Okay, so everyone's here, ready to go? Okay. Welcome to Share Club. Share Club is one of the amazing benefits of working at Simply Wall Street. Every 2 weeks, we get together and we just discuss investing. So Share Club is not a service, it's part of working here. It's more about learning and just having fun and being social. So anyone watching this, please do not take this as stock recommendations. It's all about improving ourselves as investors. And actually, if you go to the next slide, Emma, you'll see a nice big disclaimer.
I'll share my screen. Can you guys see that?
Yeah.
Yep, cool. Alrighty, well, thanks for joining, everyone. Yeah, as Emma said, I'm going to be talking about Mastercard. So full disclosure, obviously this is just a prezzo. Do what you will with this information. Just my opinion and what I've figured out from, or found from a bit of research and why I like the company, and yeah, just going to talk a bit about it. So I'll start off just to give you an outline. Today, I'll just try and first off explain how I find my investments, whether it be like where my sources are, or just like what I tend to read and look into, and where I look for ideas. Then once I've found an idea, basically what I look for in a company. So it's very similar to what we talked with Owen about last week, similar sort of principles. And then I'll explain my thesis on Mastercard, my estimated valuation, and then some of the risks that I see that the company's exposed to. So yeah, first off, how I find my investments. So pretty much it's evolved a bit, but as of late, it's basically just I look in a few key areas. First off is basically, is there any products or services that I use? Now the reason being is because obviously a few of you might know Peter Lynch. He basically says sometimes the best investments are sitting right in front of you, where it could be the stuff you interact with daily. For me, it was I was unaware of it at the time, but I've been using Mastercard for years with all the debit cards and everything. So I only stumbled across it recently as an investment opportunity because of the second point there, which is some podcasts I listen to. So I listened to a few podcasts, but more specifically this one where I actually gained the insight of what the business is called the Investors Podcast. Those guys on the right there, Preston Pish and Stig Broderson. I love their podcast. So if you guys are interested, you can check it out. Basically, it was episode 281, and they talk about Mastercard with this guy called Sean from Ensemble Capital. And it was just a fascinating episode, and gave me some real insight into why Mastercard was so attractive as a potential investment. And then it basically led me to do my own research. Before those things though, how I typically used to find stocks was I just look at my favorite investors. So the likes of Warren Buffett, Guy Spear, Manish Prabhai, Hamish Douglas, those kind of guys. I'd look at their holdings because a lot of the time they actually have to disclose them because they're public. So a big tick for me obviously was when I looked into Mastercard, I found out that Buffett and Hamish Douglas both own some in their respective entities. So that was quite appealing. It was basically a big tick of approval from them as well. I use that just as a way because like I invest with similar principles to them, and I know that basically they're the ones who spend so much time and money and researching these kind of things. And if it's basically past their thresholds, then it's likely going to pass mine as well. So I don't blindly follow them though. That's just a word of advice. I don't just copy and paste because they might invest in business that I don't understand. So I'll get into that in the next one, but I just basically used to find investments by looking at them. So the next one. So yeah, then, sorry. So yeah, once I've found a company, in this case, Mastercard, there's 5 things, which is what Owen touched on last week about what I look for in the company. So the first thing is basically, is it within my circle of competence? And that kind of has been touched upon by Buffett and Munger when they talk about, is it in my realm of understanding? You know, like, am I capable of understanding the business model? Because if you can't understand the business model, then it's very likely that there may be some developments that you just don't fully understand. So basically developing the first point of call is understanding that learning the business and basically understanding how it works, how it makes money, how it incurs expenses, what its market is. All those sort of things are crucial to first understand. Then once you're happy with that, basically the next part is developing or learning about whether or not it has a durable competitive advantage, which has otherwise been called a moat. So you guys may have heard the analogy of a moat being around a castle. In the business world, that basically is a whole bunch of different types of moats. So they could be network effects, switching costs, brand power, intangible assets, and the like. And so basically they are protecting, the castle is the business and they're protecting the castle's earnings. So fending off competitors who might try and attack the castle and take some of their market share. If a company has a strong moat, basically it's protecting its earnings. So you want to identify a company and invest in a company that has a way of protecting itself. So an example of that might be Coca-Cola with its brand. Like everyone knows a Coca-Cola brand. Therefore, when you get the choice of a Coca-Cola or a home brand Coke, most people are going to pick the actual Coke. That's just part of their moat. But that's been going for years. So the next thing I look at is the company in an industry with long-term structural tailwinds? Basically, I am not one to look at these industries that I haven't, trying to identify companies here and there that might be like a good one-off opportunity. I find a good place to start basically is what's a long-term structural trend that is playing out that I can be exposed to, and then try and find an ideal company within that structural trend. So an example is like back in the 90s when e-commerce was starting, you might have had the likes of Amazon. Then in 2010, people might have said, oh, e-commerce has already played out. And you're like, oh, well, it's probably got like another 20 or 30 years left in it. It's still growing. It's still happening. It's a big long-term structural trend. In this case, Mastercard is exposed to the structural trend of digital payments. So that's what I look for in this case. Well, that's what I noticed when I was looking at this case. I try and avoid industries that are in decline or just outside of my circle of competence. I don't understand mining. I don't understand biotech. I try and steer clear of them. Just reverts back to the first point of staying within my circle of competence. Next thing I look for once I've identified those is the management team. So basically I look for a company with solid management. So someone or a team that is honest, intelligent, and integrity driven, because ultimately these people are going to be the stewards of your capital. You're allocating them money by buying shares in their company. So they're then going to be managing your money effectively. So do you trust them? Do they treat you like partners? Are they honest with you in annual reports? Do they, trumpet their successes as much as they own up to their mistakes? They basically, do you trust them? And are they going to do the right thing in terms of allocating your money? So that's the next thing I look for. And obviously a track record is a great thing to look at in that as well. And then the last bit is obviously valuation. So is it trading below my estimated valuation? Now, as many of you probably know, valuation is very hard. It's an imprecise art and a science, so it's reliant on assumptions, it's reliant on inputs, all that you as the investor culminate yourself, or you come up with yourself. So depending on the numbers you put in or the assumptions you make, your evaluation of one company might be very different to someone else's. So when it comes to this though, I put in the assumptions. I understand that I'd want to be approximately right rather than precisely wrong. So I just chuck in a few numbers that I think are warranted from a bit of the research or based off the research, and then basically only try and buy when there's an attractive margin of safety, which basically means if I think something's worth $100, I'd love to buy it at $50. So that there's a bit of a discount. So then that takes us on to Mastercard. So Mastercard, basically, many of you probably already, well, you definitely know the brand, I assume, but basically it's a global digital payment processing company. So they facilitate the transaction of money all around the world, both nationally and internationally. They basically provide the networks or the rails for the movement of money. I'll show you in the next slide. I think it's the next slide or the slide after, of how a typical transaction works. But basically, if I go and buy a coffee, my card, I swipe it, and Mastercard is the one facilitating the money from my bank to the cafe's bank. So they're the ones who are facilitating the money moving around, and it's a very important process. It happens in a matter of the first part happens in a matter of seconds, but it's very complicated, and they make it happen very easily with their network. To give you an idea of the scale, they basically do around, or have done around 74 billion transactions a year. That's just the number of transactions. I believe the dollar value is in the trillions. So they're dealing with a lot of money, and they typically take a very small clip. So one thing that's often misconceived is when someone says, oh, a card has, or the merchant might complain that a card has 2% fees. It's interesting that most of that actually goes to the bank. The merchant, or sorry, not the merchant, that Mastercard actually typically only takes a very small slice of that, which is around 0.2%. So they're not the ones who are typically charging the high fees. It's typically the bank that's issuing the card. Mastercard just facilitates the transaction. So with Mastercard's business, it's essentially a huge data center. So they have these data centers around the world that are the infrastructure that facilitates all this movement. So that is the core of their business. And it's obviously very valuable to them. And that's how they have so much data stored there. I think I made a note. Yeah, the data they're storing there is just incredibly valuable in today's society. So there's people like investors and policymakers and advertisers who would like access to that data, obviously for a price. But yeah, it's the kind of stuff that's how their business works, by facilitating transactions where they contact the banks and they give them the details they need from the purchaser and vice versa. So they have a few non-core supportive businesses. As you can see on the right there, they've got analytics, cyber and security, loyalty and rewards, and I can't see the corner. Consulting is the other one. Typically, their data and security businesses are doing well. I'll touch on them in a second, but those businesses are actually doing well in recent times. But their core business is the payment processing. One thing that's misconceived about Mastercard is they're actually not a bank or a lender, or really a financial stock. They are just the facilitator of the movement of money. They don't lend. They don't do all the typical transactions or processes of a bank. They just facilitate the movement of money. And then just on the history, basically it was founded in 1966, and the story is actually a bit interesting. It was, that's right, there was a first, oh, I've lost it. No, sorry. It was originally called Interbank. I was trying to find the original name. It was called Interbank, and then they changed their name to Mastercharge, and then eventually they changed their name to Mastercard. But yeah, 1966, so they've been operating for many, many decades. And they were originally actually formed as an alliance between multiple banks to take on this card called Bank Americard. And funnily enough, it later became the Visa credit card. So those guys have been competing for quite some years now. But yeah, that's their history. So that's just the anatomy of a transaction. I won't go into it too deep, but at the first part, there's the authorization, which is the first couple of seconds of when you buy your coffee, for example. The clearing is the next part, where the Mastercard makes sure, or sorry, it tells the banks all the details of the buyers and the sellers. And then the settlement is basically actually the moving of the money, the final part of the transaction. So Mastercard's business is they facilitate all that, which is obviously very valuable to the whole global digital payment space. To get back to the first part, just my circle of competence. So am I capable of understanding the business? So what I did first was started reading reports, the annual report, McKinsey industry reports on digital payments, and then articles on different platforms and areas like that. Then I used the product, so that helped in sort of my understanding of what they do. Understanding what can go wrong. So I read, while it's all good to read all the good news about what's great about a certain company, it's also very important to read what can go wrong. So understanding both sides. I'll get onto that later. Understanding who their competitors are. So who are they competing with? In this case, it would be Visa, Bank of America, American Express, and then in the likes of China, they're competing with Alipay and WeChat. But to my understanding, they've only just recently entered China, but I would almost say China's sort of a lost cause because Alipay and WeChat have those markets down pat. They've basically done to China what Visa and Mastercard has done to the rest of the developed world. So it's kind of tough market they're entering there. But yeah, as you can see on the right there, that's a basic layout of the how a typical transaction works. So competitive advantage was the second point of what I look at when looking at a company. And to be fair, that well, the first thing that obviously stands out is their network effects. So the more people that join Mastercard's network, the more valuable its offering becomes to its customers. So, or to any of its customers. So they have a whole bunch of merchants signed up. They have millions and millions of merchants signed up, and billions and billions of cards outstanding, or not billions, millions of cards outstanding. And basically, the more people that get added, the more valuable the network gets. And an example of that is like, if I fly to Italy and I have my debit or credit card and I go to swipe a transaction and they accept Mastercard, you know, that is incredibly valuable, because if I was to go to a certain place and not have my card accepted, it's kind of frustrating. You have to use cash. In this case, Mastercard has such a vast and wide network where it's accepted incredibly widely around the world. And that just makes it incredibly valuable, or their offering incredibly valuable. Very hard to underprice. So that comes back to basically one of the moats is lowest cost producer, but in this case, it's very hard to underprice them because they charge that, or they take the 0.2% of each transaction. So if they were to choose to try and undercut each other, so this is between Visa and Mastercard, for example, they're operating, and I'll touch on it in a second, in a duopoly or an oligopoly, if you consider a few others. It's very hard to underprice them because at the moment, the existing players take that 0.2, and if they wanted, they could compete with each other, but it really wouldn't stand to benefit much because yes, you might gain a tiny bit more market share, but maybe at the cost of hurting your own business. So at the moment, their costs are very low, so they're very hard to underprice. One thing that I found through the research was that fintech disruptors actually use their networks or rails. So one thing that really solidified that was when the Apple Card came out. I was quite concerned originally when I heard about it, that this was, I think, 2018. They were going to, they could use all their data that they had. This is what Sean touched on in the podcast. He said they could use all their data, everyone's iTunes accounts or Apple accounts. They have all their emails on file. They have all their bank details on file. They have everything there. They could do it themselves. And yet when they made the Apple Card, they still chose to use Goldman Sachs as the bank and Mastercard as the network. So the fact that the disruptors are actually using the rails and networks is a big competitive advantage, because it's basically a testament to how valuable their offering is. And another thing that was quite insightful was Sean heard from some few venture capital funds, and he said of a lot of the fintech companies, he said not many of them are trying to compete with Mastercard or create a competing product. A lot of them are trying to build their offering on these networks and not necessarily trying to make the next Mastercard or the next Visa. They're trying to offer just a more convenient way to pay, and they happen to use those networks. Trust was a fourth thing that I found would be a competitive advantage, because there is an ultimate underlying trust that when any of us who uses our cards, being a Mastercard or a Visa, there is an underlying trust that the transaction will go through. There's never really any doubt when I go and use my card that, oh, this person might not get paid, or this cafe might not get paid. There's an underlying trust in there that the system will work and the money will get to the bank where it needs to go. That's very valuable, and they've built that up over years and years and years, and that is obviously the brand power of Mastercard, knowing that if you make a payment or a transaction, your money's going to go where it needs to go. Duopoly and oligopoly, basically the reason I bring that up is because when you're operating in a space when there's a few major players who own the majority of the market share, you tend to have quite favorable economics. You're not all competing on price. You're not trying to disrupt each other. You basically have the dominant market position. And in this case, Visa and Mastercard, they basically own the payment space in the developed world. So with that being said, they are in a very favorable position. Margins is just something I look at. So when you have competitors entering your space, often it'll show up in your margins, where you see your margins are decreasing, or maybe because competitors are chipping away at your market share. In this case, their margins have been increasing and just very, very high. Like, it's just very, very appealing. So I'll get into that later in the numbers, but yeah, those tend to be a telltale sign, and they've been very strong at around 58%. They've just dropped to 51% this quarter just gone. But yeah, 58% margins is very impressive. And then the brand, data, and technology, the competitive advantage there basically is the brand, as I mentioned, with the trust. And the data is obviously the valuable data that they have access to through their networks. And the technology is they're basically working on, they're not sitting still, and they're not typically like most incumbents. If you're an incumbent in an industry, often people tend to sit still, and just that's when disruption can come in and be very active and actually hurt your market share. These guys are being very proactive, like that they're trying to move forward and constantly update things. So you may have heard of their tokenization. Basically, rather than sending bank details between different banks, they allocate you a token, and that's what is on the right here, where rather than sending all your bank details, your name and your expiry number and everything to the merchant's bank, they'll send you a token, and in their network, they have all they have to send is the token. So basically, with that, it's a much more secure way of transacting. And I hear it's very similar to encryption, so that's also helpful. Then on the industry tailwind side, basically, as I mentioned, as you know, Mastercard is in the digital payment space, and there is a structural decline in cash usage. So less and less people are using cash. It's surprising how many still are in countries like America and other Western countries, but there is a big decline, and it's structural, and it's still occurring, and it is playing out. And these guys are set to benefit from that because they're in the digital payments as opposed to physical cash. So from the McKinsey report I read and a few others, basically the estimation is that total digital payments in the world were 3.7 in 2019, 3.7 trillion in 2019, and they're expected to be around 12.7 trillion in 2025. So quite a bit of growth there in terms of just their overall market that they're exposed to. Increased smartphone usage, that is obviously contributes to the increase in digital payments, but yeah, 5.6 to 7.4 billion is over the same period for 2025. Mobile payments and e-commerce, again, that contributes to the digital payments, but the fact that those are growing ways of the way we pay, Mastercard is set to benefit from that. And yeah, then the increasing demands for data and security. So there's a lot of people, like I mentioned earlier, investors, policymakers, advertisers and stuff, who want access to this sort of data. And Mastercard can provide these analytics or this sort of data. So that's obviously not people's personal details, but the data they have is valuable. And their offering in terms of their cybersecurity is very important as well. I'll touch on that later in a mention on what's happened recently. But yeah, those two actually performed well in the second quarter of this year. Solid management. So as you know, that's the third thing I look at. When I was researching them, I read about Ajay, and he's been the CEO there for the last 10 years. And he's actually stepping down at the start of 2021, which is a real shame. But he's basically going to stay on I think he said he's moving to chairman. Yeah, he's moving to executive chairman. But that guy has served there since 2006. So they've basically all worked together for a while. Ajay is being replaced by Michael Maybach. I think that's how you pronounce his name. He's the chief product officer. He's also been there for 10 years, and he's promoting the multi-rail approach. So basically in diversifying their offering to customers and trying to provide more value through their offering. So I like the way he's been working, and Ajay has attributed a lot of their multi-rail success to Michael. So the fact that he's now moving to CEO feels like it's a competent or a good choice for a replacement. And yeah, that's obviously resulting in diversifying their income streams. It's all well and good to have a core business of payments, but it's sound to try and increase your offering and diversify your revenue streams. So that's what the data and security and the consulting and the like can offer. One thing I noticed is, like I mentioned, they're not sitting on their hands. So with the acquisitions they make, what I like about them is that they're not making acquisitions just for making acquisition's sake, which is a very common thing, and Buffett calls it the institutional imperative. But basically, the acquisitions they're making are all, from what I can tell, value add. So they're not just pursuing acquisitions for size. They're actually pursuing acquisitions in terms of how can this increase the value we add to our customers. And so far, they have proven quite profitable and proven that they've been good acquisitions. So I've liked the way that they're allocating their money. And then the Mastercard Foundation, that this isn't more of a financial choice, more of just a ethical choice, and nice to see. Basically, a few of the videos I watched about Ajay, he talks about how they have so much influence in the space, so much influence in the world, and they want to use their influence for good. And so they have the Mastercard Foundation, and they have a goal of, I think they said, connecting 1 billion people to the digital payment space by 2025 through their network. And I think they got to 500 million just gone at the start of this year. So they're halfway there and they're doing well. And another thing is they look to empower small businesses, educate young children in developing nations, and empower women business owners in other nations. So I like that, what they're doing there with their foundation. And then he also talks about the decency quotient. So something that I hadn't heard of before, but he talks about how like IQ is very important, EQ is very important, but DQ is what he cares about the most. And he's referring to a decency quotient where he basically just says, when you being a decent human being is the gist of it, where he talks about rocking up to work and doing your best, being honest, and basically making it a fun place to work, and so that people bring their best and then produce the best outcomes. And he says if he exemplifies that as a leader, and then that trickles down through other leaders, it basically then encompasses the whole company. And it's quite a great thing to know that the leader is promoting that. And one thing I found really interesting as well, as he touched on in one of his YouTube videos, was he used to work at Citibank, and while he liked it there was 387,000 employees, and he said it was just very hard to have a person-to-person sort of interaction with all of them, obviously. And he said he just felt like he was running like a faceless sort of army where he couldn't really have these interactions with people. And then so he got the offer from Mastercard, and at the time there was 5,000 employees. So obviously way less, and much easier to build those relationships with his employees. And when I heard that, basically it was a real tick to hear that he cared about that sort of stuff. And interestingly, Citibank has now almost half their employees to 200,000, and Mastercard's now almost doubled to 11, or more than doubled to 11,000. So still smaller, but growing. And then the numbers basically were the nitty gritty. So I've used our site here on the right, but basically, if I could design a business model, it would be what Mastercard has. Sean talks about it in the podcast, but I just couldn't get over the numbers. So typically their margins are around 58%, which is incredibly appealing. So he also described the business as being a capital light compounding machine, which is exactly what it is. Like they earn so much money, but they don't need to reinvest in the business. So, or they do, but they don't need to reinvest all of it. So it's very capital light. It's not like they have to allocate a whole bunch of money like to keeping up their growth. They're growing anyway, and they pay out a lot of their earnings to shareholders, which I'll touch on in a sec. But so their revenue growth over the last 10 years has been about 13% a year. Earnings growth has been about 70%, which is per annum, which is great or crazy. Free cash flow growth is about 19%. Dividends have been growing and conservative. So back in 2010, they were 6 cents a share, and now they're $1.40 a share. And so that's a growth rate of 44% a year, which is quite impressive. And even still, they're only, I think, about 20% of the company's earnings. So when you hear that, it's great to know that the company's, able to grow its dividends incredibly quickly, but they're still a pittance of what they actually earn. So this is a company that's been around for many years, still growing incredibly well, and it's paying a growing, very quickly growing dividend, and it has no signs of slowing down. So it's quite appealing. So, and the buybacks. So they earned, just to give you an example, they earned 8.1 billion last year, and of that 8.1 billion, they returned about 6.3 to shareholders in the form of buybacks. So, and the remainder was in the form of dividends. So about 1.7 or so was in the form of dividends. It's an amazing business model because they're growing and they're earning so much money and they're returning so much to shareholders, which doesn't typically all happen at the same time. Typically you have a growth stock that wants to retain all of its earnings and basically keep reinvesting in the business and reinvesting, and they're not returning any money to shareholders because they're pursuing growth at all costs. What you have with Mastercard is almost both, it's also exemplifying what a mature business does, where it returns all of its money to shareholders. So you've got a business that's not only growing very quickly, it's also returning heaps of money to shareholders, and it's just like a double whammy. So I found that very appealing. And then in the balance sheet, basically their debt is about 4% of their market cap. They've got 12 billion in debt of a $330 billion market cap company. So very conservative. They've got like 40 times interest coverage ratio. So they've got it well covered. If they wanted to pay off all their debt, they could just take 1.5 years of earnings and pay it off just like that. So it's very, very conservative. And then, yeah, like I mentioned before, they're very profitable. So their return on capital is about 40%. All very juicy numbers. So here's the valuation. Now, just some of these are the inputs that I put in would come from the estimations. I'll take a step back. The inputs that I put in come from the estimations of what I believe continue to happen or will continue to happen. So to start off with, the valuation of a business, as we've probably touched on before, is the discounted future cash flows discounted back to today's price. Sorry, it's the future cash flows discounted to today's price. And what we have here is basically a company that when you try and value it, typically, you'd take all the future cash flows, discount them back to today's values. So you've got to figure out, are those cash flows growing, and then how to discount them back. And the number I got with was 360. So the reason I mentioned that is because, how I got there is what I should say, was I used the 20%. I started with the 20% growth rate, but then realized that was a bit optimistic. While the analysts do forecast earnings to grow at 20%, I took a few percentage points off because I just wanted to be a bit conservative. And so took that out to 10 years and then brought it back. And I like the predictability of the business, so I can feel confident about the forecast. But yeah, bringing that back to my fair price, it comes to $360. And now that might be the fair price of the business, but ideally, like I mentioned at the start, when you buy something, when something's worth $1, you don't want to pay $1 for it. So that's when I got to the margin of safety. And it's ideally you'd want to pay less than 252. In this case, would be a 30% discount to that. So anywhere with my assumptions, anywhere below 252 would be a good price to pay, because that's basically, as I put it just there, 252 or less, because I believe the earnings growth rate can continue. If for some reason I was to think that the earnings growth rate was to slow down, then I'd say you'd go anywhere from 205 or less. Basically, I think going into details in the valuation, we could probably do it in another prezzo, but just for the high level stuff, that's sort of how I got there. So back in February, I read about it, and it was before stuff started happening, and then quickly ran some numbers. So just full disclosure as well, these numbers are a bit old. They're about 3 months old. But yeah, then obviously the stock market started crashing, and I was only able to pick up, I wasn't able to pick up everything I wanted below 250, but still got in some of them at the time. Had to act quick, but apparently I didn't act quickly enough. Yeah, and so some recent catalysts. So, sorry, I'll go back one. As things change, I will probably run these numbers again. I typically try and do it 4 times a year. So as earnings releases come out, I just want to find out if anything changes my thesis. So if the inputs need to change, if I will change them, and then if that changes my valuation, I might change, or I might buy or sell more. So yeah, that's just basically a way of monitoring the investment. I try and check it 4 times a year, or rerun the numbers 4 times a year. Some recent catalysts that happened, just thought it was interesting, was in the second quarter, the cross-border transactions that they do, they dropped by 45%. Obviously, that was because of COVID, and that was about $707 million worth, and that accounted for nearly all their revenue drop. So what I took away from that was basically their core business of processing payments was still solid, and the other businesses such as the data and the security still held up well. And actually, I noticed in the same report that they were actually up 10%. So in this last quarter just gone, which was quite reassuring. And then I mentioned before the Apple Card, so that's actually a bit old. So, but the Apple Card adoption rather than disruption, that was just a nice sort of tick of approval, as into competitors not becoming competitors, basically, or using the network rather than trying to build their own, is what I should say. Yeah, their security offering becomes more valuable as the e-commerce industry grows. So they can provide more value to customers in terms of helping them prevent fraud and the like. And then, yeah, that like I mentioned before, that the amount of money that goes through their networks, which is around $1 trillion in quarterly transactions, becomes increasingly valuable to advertisers, investors, and policymakers. So that's another potential revenue stream. And one thing I thought was interesting, but I haven't looked too far into it yet, was the crypto card program they've just recently announced in June. I need to do more research on that, but I'm wondering, they're delving into that space. Obviously, it's more of a proactive move of they don't want to be sitting on their hands and waiting. So they're trying to be a bit proactive about it. Yeah, now obviously there's risks. There's always risks involved with everything. So one thing that Charlie Munger says is invert, always invert. Like, yes, you may have a thesis, but it's like, what can go wrong with it? So when looking at Mastercard, basically, I see these as risks. So regulation, there's plenty of times in the recent history where they've been caught out by government, not called out, but governments have called upon them and they want to review their business and make sure they're doing everything right. So they would be subject to regulation where maybe the regulators want to cut the fees that they charge or impact their business in some way. So that's always a risk that could arise. Cybersecurity, say someone hacks their data centers, that's always a possibility, or somehow hacks their system. That's a risk. Digital currencies is another for them to, for new starters in the space to come out and bring in something that's better. Server meltdowns, they can happen, and there's a risk of them. Settlement risk, that's just in regards to the processing of transactions. Now, I don't know that area too well, so I'm still looking into it. And then, of course, any black swan events that I haven't even listed here that could happen, that's always a possibility. So, yeah, and that's pretty much it. So Mastercard, to sum it all up, is a company that is, I suppose, within my circle of competence. I'm still trying to learn more about it, but it's within my circle. I found it has a large, durable competitive advantage. It's in an industry with long-term structural tailwinds. It's got favorable growth prospects. It's by itself. Solid management, so I like who's running it and who is now going to start running it from 2021. Their balance sheet is pristine. You can't fault it. They've got very, very little leverage. And then in terms of the current price, I think it's currently trading around 330. So my valuation had anywhere below 360. But of course, like I mentioned, you wouldn't want to pay full price for it. So ideally, you try and buy it at a bit cheaper. So my price was 252, but that's of course just an estimation. So yeah. And then yeah, things just to remember when I'm doing those valuations, just trying to weigh up the probabilities of what goes in, and then just using rules and checklists to make sure I tick all the boxes. And then my assumptions and inputs can change as developments happen. So yeah, that's pretty much the preso. So sorry I dragged it out a bit longer than I thought, but thought I would. I hope that was interesting. Do you guys have any questions?
I think there's a few questions, Mike. Just letting people. Yeah. The office internet just got disconnected as usual, so a bunch of people sort of
really went
down, but it's fine. Okay. We're online. No, great presentation, Michael. That was awesome. Yeah, really nice, really in depth. And I think so. Just to be clear, when did you buy Mastercard?
Around 220, 230, and 240. So yeah, that's what I was buying, and then I didn't get in at 250, but yeah, I just missed the rest of it, and then I sat on my hands for a bit and proceeded to watch it run a bit more. So the reason why I mentioned the valuation needs to be redone is because second quarter results are out, and I'd like to redo the thesis and see if I need to change any of my inputs and if a higher price would be warranted. You know, now that I can see data and security is clearly growing, I'd be interested to see if that warrants maybe a higher price, or the fair price actually increases a bit.
Yeah, absolutely. Just to be clear, so you bought it in the COVID crash, or you owned it before the COVID crash?
Bought it in the COVID crash. So I learned about it in February, and then did as much reading as I could at what was in this preso, and then started buying in the COVID crash as much as I could, and didn't finish. But
nice. That's I mean, that's like a very rare discipline of investing, because you've made your valuation, you've said I'm not buying until it hits it, and then it hit it, and then you bought, and that looks like it was a great decision. So that's great. It shows that you also, one thing you didn't mention here is patience. You need to be very patient. So
I should mention that. Yeah, I got very lucky.
Well, no, I don't think you got lucky at all. I think there was a crash, and like the fundamentals of the business didn't change. It's still a great business, and that's why that's exactly how, how people should be thinking about making their investment decisions. So unfortunately, the rest of us might have missed it, but that's our own fault. So
it might still be an opportunity, because I think it's a great long-term hold. That's just me.
Yeah, maybe. Yeah, we just, it's the what's the correct bias for that? The where you've seen a previous price, therefore you want it to return to that price.
Anchoring.
Yes, anchoring. Yeah, I'm anchored to your price now. So if you got it for that much, I want to get it for that much as well.
Yeah, 240 on nothing.
Yeah, I've got price envy. A few people are asking, simple question: why Mastercard over Visa?
Sorry, guys. We actually got logged out for about 6 minutes.
Yeah, that's fine. We just join in. Yeah.
But should we not go back and just for the video? Because it's gonna just
the video was still recording, Emo.
Oh, okay.
Yeah, so we can review it. But yeah, we can. So I think you guys can go back and review the recording. It's still, like, it says still recording on my screen.
So yeah, the question as to why Mastercard over Visa. So I was looking at both of them beside each other, and then basically it was kind of, once I got to management, I kind of had a soft spot for Ajay. I kind of really liked his story, and I really liked the way he does things, and just the fact that he was running the company, I kind of then steered directly towards there. So I would say I didn't finish my research on Visa, but I saw Mastercard was my choice once I kind of got to the management side of things.
Yeah. Okay. So that was the big change. I mean, apart from Ajay, do you see any fundamental differences between Visa and Mastercard from a business perspective?
I mean, they both really dominate the developed markets payment space. So I don't see any huge drivers, because they're both really aggressively investing in new ventures like business to business payments and the like. So I think both of them are incredibly good companies. I haven't done a valuation on Visa, so I wouldn't know what number would be a fair price in my opinion. But yeah, I would say that both are really good bets in terms of being exposed to that sort of market. And they're both incredible companies. And yeah, they're both sort of actively, like, if you look at their acquisitions, a lot of them do line up in terms of like similar businesses. Like you'll see one of them buys a sort of supporting non-core business, and then one buys very similar sort of business in Europe as well. And it's yeah, I think they're both very similar companies, but yeah, I just lean towards more Mastercard for that reason, for the management.
Yeah, what's the market cap of Visa versus, I can't remember, that's a bit smaller, isn't it?
I think it was a bit bigger last I checked.
I haven't, yeah.
Yeah, 422. So
yeah,
Mastercard's 330, or roughly.
Yeah. Because, yeah, to your point, Visa recently announced they bought Plaid. And actually, I hadn't appreciated, but MasterCard bought something called Finicity before that. So they both thought, hey, let's go buy a, nice data aggregator to scrape all the banks. But, yeah.
Yeah, that's right. So there's similar acquisitions playing out.
Yeah. Okay. So, guys, we need more questions, guys. What else is on the list? Let me have a look. Thoughts on any of the other competitors or disruptors, Amex, PayPal, Square, any other thoughts on any other companies in the payment space, I think is the question.
I will admit straight up, I need to do more research on that. So my opinion at the moment, though, without doing further research, is Square's seller ecosystem uses MasterCard, Visa, and American Express networks. So that's kind of like they've just teamed up with that. And I only learned that through the Jim McKelvey book, The Innovation Stack. But they're with their Cash app, for example, that obviously is them transacting money within the Cash app network. So that could definitely be a disruptor. They have, I think, like 30 odd million users on that. So there's certainly space for them to grow in that. And they only charge a fee when they take money out of the Cash app. PayPal and stuff, my understanding of their business isn't as thorough as it could be. At the moment, I would say, yeah, there's definitely room for the disruption, but they haven't, I mean, they've been around for 25 years. So I'm not saying they won't, but there's definitely like opportunities there for them to disrupt, and that's just something I suppose that I would look into further. So I see it as a risk, and part of my research, ongoing research now, would be finding what the competitors are working on.
Yeah,
like
absolutely.
PayPal and Amazon and stuff. Yeah.
Yeah, absolutely. Yeah. I think I remember we used Mastercard a lot as one of the example companies in a lot of our research. I think the more we were using it and doing user interviews, etc., and doing these prototypes, I was like, damn, this is a pretty good business actually. Like maybe we should buy this. Like, hang on, this is actually great. And we're doing all these prototypes and things. So yeah, it was interesting. Okay,
exactly. Like the more I looked at it, I was just like, oh my God, this is great.
Okay. Maro wants to know, how long do you typically spend on your research?
Good question. It can vary. So the process is, like, I always try and follow the checklist. So the checklist of, there's a few sub points within those main 5 points of competence, competitive advantage, industry, management, and value. There's a few sub points within each of them. So I'd probably say for me to get through every part of the checklist would take like, I'm just trying to figure out. Honestly, probably like 15 to 20 hours maybe of like research before I have a rough idea. And then often what I do is I just keep digging away at it. So it can then take up to like, 30 hours maybe of research. But yeah.
Okay, that's quite a lot. Well, now we just listen to your talk with it. I'm just going to buy it straight away. So yeah.
Please don't. But yeah.
No,
or do, I mean.
No, I've been interested for a while. I wasn't as attuned to you when it dropped, to be honest. I wasn't ready with my valuations. It's quite a lot of questions about crypto, and I guess the kind of thesis that, hey, crypto can totally disrupt payments, which doesn't need explaining. But what is your thoughts, honestly, does that impact your thesis? You mentioned it as a risk, but how seriously do you take that in terms of the future of Mastercard?
Yeah, certainly a risk. And I tried to look at the differentiation between how long it takes for them to do transactions. So I think for blockchain, or you guys can correct me if I'm wrong, but my understanding was these sort of transactions with these digital currencies take a few minutes to do. So I read that, I mean, correct me if I'm wrong, but I read that somewhere. And the time for a transaction on these sort of established networks was very quick, like literally a couple of seconds. So when I read that, I was like, okay, the transactions do take longer on the digital currencies and on their blockchain networks and stuff. But I wonder how it would be for people to adapt to start using it. So would a cafe, like there is obviously a few cafes and stuff that I've seen that have started accepting it. So it's certainly a space for it to disrupt their business. And the reason why I suppose I'm not running for the hills is because I see their value add non-core businesses sort of helping the growth continue. So the data and security side of things, when I saw that increase by 10% in just the second quarter alone, I was really over last year, I was impressed by that. So their offering through that is something that's now exposed to the e-commerce and other spaces. So while their core business at the moment is payments, and they could very well get disrupted by the new digital currencies, they're sort of being proactive about it and diversifying their offering and their business model. So it can definitely disrupt. I see it happening, and I just would my opinion is I can see them existing coherently in the next few years, and then maybe 15 years down the track or 10 years down the track, it might be more widely adopted with digital currencies where hopefully Mastercard has pivoted by then and has a new business model where it's not as reliant on payments alone.
Yeah, totally. Yeah, I mean, it sounds like they they're quite progressive and innovative anyway. So, and I guess what's interesting is that Mastercard is not a currency. You know, it's the rails. So like, it's also not straightforward to compare crypto to Mastercard, or you could theoretically, Mastercard could adapt to make it easy to access your crypto on all the points of sale which they've achieved, which is huge. You can't do that overnight. So it is super interesting. Okay. Sam wants to know, what other tools were you using for research? You know, don't make us too jealous. You know.
Well, you'll be happy to know I use Simply Wall Street for getting a lot of those numbers that we obviously offer. So I wanted to know all the details about their debt and their financial statement, their financial health and their insider transactions and that sort of stuff when I did those different areas of research. But to sum it up, I used, obviously, like I mentioned at the start, I used the podcast to learn about it. And then I read a lot on Seeking Alpha. I like some of the articles there because I love reading the people who have opposing opinions and I want to know what can go wrong. So the people who are like, nah, it's way too overvalued, it's going to suck. I'm like, why? So, so I read on that. So yeah, podcast, Seeking Alpha, and then Excel spreadsheets and Simply Wall Street, obviously I use as well. And yeah, it's pretty much the tools, you know, the rest of it was just a lot of reading and then coming up with, coming up with a thesis. Yeah,
that's good. Maro's obviously long crypto, so he's short Mastercard. All good. Any other? Okay. The last question, Tim. What is your? Have you got an exit price? Have you got a target that you're looking for it to say now? This is it, or
Good question. I haven't at this stage got like a hard and fast rule, but basically similar to what Owen mentioned last week, is if it's an opportunity cost thing. So at the moment I'm bullish on the thesis, and if there's an opportunity cost where like a better opportunity comes up, I would look to trim some of the holding. But in terms of an exit price, I haven't done enough. I mean, like I'm not making a comment really because I kind of want to look at Q2 numbers again. And then redo the numbers because I feel like the ones I have, even though they're 3 months old, I just want to know how they're going through times like this. So to give you an honest answer, I don't have an exit price in mind at the moment. That's why I'm keen to do evaluation again.
That's again, it's not, that's the right answer because otherwise you're just making it up. But I think what's really interesting, one of the kind of joke questions was about your watch list, but I think you've actually answered it because what you're saying is 4 times a year you revise the valuation, you come up with your targets. If it hits it, you buy, and that's actually a great way to invest. To first of all take it easy and stick to what you've decided on, and just pray for some more COVID events. To let those prices come down. No, I'm joking. Okay.
Just non-health related.
Yeah. Any sort of last questions? Looks like crypto is blowing up, but we'll ignore that for now. Any last questions? Okay.
One comment I will make on that crypto stuff is like I'm also optimistic on it. Like I certainly don't. I'm not a bear. Let's put it that way.
Yeah, that's good to know. Actually, yeah. I think you can still be long Mastercard and still, long crypto, and you can see them both still doing well. So absolutely. Maro, do you use a watch list? If so, what app? Because Maro wants to research it.
I don't have a. Yeah, I was gonna use the Simply Wall Street one when it's made.
Okay. You guys can take that offline. Okay, take it offline. Yeah.
No.
Yeah.
Sorry.
Well, so one last question: Do you use technical analysis? That's not a trick question. No. Yeah. Good answer. Okay. You can still keep working here. No. I'm joking. Okay, that's been 1 hour. So that was a great talk, Mike. That was awesome. So really well done. Thanks for showing with that, I think the share price is about to skyrocket now that the whole team is about to buy Mastercard. Shoot Michael a question afterwards. We want to really dive into that valuation at some point.